The top business stories live from the Sky News City studio. Shares of Curries fall sharply after full-year profits fall by 38%. Bank bosses to be quizzed by the regulator on whether they're passing on interest rate rises to savers. I'll hear from the chairman of the industry body. And the money transfer group Cab Payments debuts on the London Stock Exchange in one of the biggest flotations this year. Good morning, this is Business Live with Ian King. Before we get into the business news, we start with an update on the breaking news that we've received in the last hour. Police say several people have been hurt after reports that a car crashed into a primary school building in Wimbledon in South London. The incident happened in Camp Road in Wimbledon in South London in the London Borough of Merton. Emergency services were called just before 10 o'clock this morning. We'll have updates on this story as we get them. Now, shares of Curries fell by 12% this morning after the UK's biggest electrical goods retailer reported a big drop in profits and said it would not be paying a final dividend. Well, Curries reported a pre-tax profit of £119 million for the year to the 29th of April. That was down 38% in the previous 12 months and was due mainly to weaker trading in the Nordic region. Earnings in the UK and Ireland were up 45% year on year. Well, joining me now is Alex Baldock, the chief executive of Curries. Alex, good to see you this morning. I mean, clearly the Nordics is a headache for you, but are you seeing signs of improvement?
Good morning, Ian. I'm certainly seeing signs of improvement in what we're doing to face into what is a really tricky market. I think irrespective of the actions we've taken in the Nordics last year, the nature of the market, softened demand, increased inflation, vicious competition, would have meant for a very tough year in any case. But with the new leadership that we've got and the actions that we're taking to self-help on margins and on costs in the Nordics now, we're confident of a significantly improved performance this year, even if the market does nothing to help us.
Obviously, a much better story for you in the UK and Ireland. Have you been surprised at the resilience of consumer spending?
Well, consumer spending has been relatively resilient, but our market still went down by 6%. In the past year. I think the resilience is more the resilience of the business that we've built in the UK. The fact that we've been able to protect our #1 market share position, the fact that we've made colleagues and customers significantly more satisfied over the year, that's been reflected in another year of sharply increased gross margins and good cost discipline, which has led to our profits being 45% up. This is very encouraging because it's been a long transformation to get the UK to this place. We know what's working. We intend to keep doing it.
Have you noticed many changes in consumer spending habits over the last 12 months?
Plenty of changes, and not all of them intuitive. So there has been some trading down to entry-level products. Some of our own label brands, like JVC and Kenwood, for example, have done well with customers looking for a deal. But we've also seen some trading up to more expensive, energy-efficient products, particularly in appliances, where we gained market share last year, and where customers are willing to pay a bit more upfront, knowing that they're going to make it back, given the state of energy prices over the life of the product. And that's done well. The other things that have done well, customers are spending more time in their home, so they're kitting it out with gaming. Has had an excellent year. They want the more premium coffee machines, the bean to cup. Has had an excellent year as well, and people seem to be favouring their own bedroom rather than the salon when it comes to premium hair care, given how well our sales have done there. So there's been plenty of shifts, but not all of it trading down towards less expensive products.
One interesting line I thought, Alex, was that more than 17% of sales now include a credit component there. Are you seeing much movement on the delinquencies front there?
No, we're not yet, because we're very careful who we lend to, and we're very careful how much we lend. I mean, we think there's a really strong case for responsible credit, particularly given our products aren't always the cheapest. Technology can be expensive, but people still need it. And if we can provide people with good value, responsible credit, that helps them. Our credit customers have significantly higher customer satisfaction scores than non-credit customers, and it also helps us, because credit customers tend to be stickier and more valuable to the business. So we're really pleased by the progress in credit that you spoke to. It's one of 3 big sources of stickier and more valuable customer relationships that we're pressing hard on, along with our repair business and our ID mobile subscriptions business. We've seen good results last year. We intend to keep them going this year.
Yeah, it's quite. You mentioned the repairs business there. I imagine that is being kept very active by people trying to wring more life out of their products.
Well, we use the phrase longer life rather than ring more life, Ian, but you're exactly right. Yes, of course, people want their expensive technology to last for longer. And this is where we benefit from having Europe's largest electricals repair centre, up with over 1,000 colleagues in white coats up in Newark doing their thing. We repair nearly 3 million items of kit every year. This is obviously great for customers' pockets. It's great for the planet, but it's also good for us because we make good money out of our care and repair products, and that's why you can believe that we're going to keep doing it because it's been a big source of profitable growth for us.
Alex, you mentioned their ID, your mobile virtual network operator. Do you have any views on the proposed merger between Vodafone UK and 3 UK?
We're broadly supportive. I mean, we were keeping our eyes on the details, but we have partnerships with both of those businesses, both 3 and Vodafone. We sell their connectivity. We have good relationships with both. I mean, ID, you touched on, has had a really good year. I mean, the subscriber numbers have been up sharply. We've got over 1.3 million subscribers in ID now, and we've got a competitive advantage in that space. We've doubled our market share year on year, and we intend to keep going with this because it's another good source of more stickier and more valuable customer relationships.
All right, Alex, we have to leave it there, I'm afraid. Busy day for your results day. We do appreciate you sparing the time to chat to us. Thank you. Just a brief update for you on the crash in Wimbledon that we brought you news of earlier on today. Metropolitan Police have now confirmed that the vehicle involved was a Land Rover. The Met Police have also confirmed that we can name the school. It is the Study Preparatory School, and we are also told that this is not, repeat, not a terror attack. We'll have more news on that as we get it. Now, the industry body for the UK financial services sector has this morning called on the government to issue a digital gilt. That's a UK government bond as a way of accelerating the digital transformation of the country's capital markets. UK Finance warns that the country risks falling behind other jurisdictions such as Singapore, Switzerland and Luxembourg unless more is done in the field of tokenisation. Well, joining me now is Bob Wigley. He's chair of UK Finance. Bob, great to see you this morning.
Good morning, and thank you for having me.
You better explain first of all to the uninitiated what is meant by tokenisation.
Yes, we're talking about being able to hold a digital token that represents your share in BP or your share in a bond of a company.
And why is this good for the UK's capital markets?
We, as you know, today lead with America the world's capital markets. We're one of the 2 leading global financial centres. It seems that the world is moving in the direction of tokenisation. So what we've been saying to the government is, yes, your focus on crypto, that is to say, tokens that are not backed by real assets, if you like, not by real financial assets, is fine. Of course, we need to have all the regulation that's coming in around crypto, but that's the sideshow. Crypto today, if you take the total market cap in the world, is under 2% of, for example, the global equity market or the global bond market. So what we need to focus on as a country, if we want to protect our position in global financial markets, is tokenisation of real financial assets. So that's what our report is about.
Why have the likes of Singapore potentially stolen a march on the UK?
So our report basically looks at 3 things. Are we behind? Why does it matter? And what should we do about it? So on the why are we behind, there are some jurisdictions like Singapore who tend to be first movers on these things, who have created specific laws to cope with digital assets. And indeed, Luxembourg has done the same. And of course, that gives them a short-term marketing advantage because it looks like they are intending to be the leader in this area. The truth is the UK actually has a brilliant legal system. And the problem with a statute that you create specifically for digital assets is that it's pretty much out of date the moment you write it because the technology is moving so fast. Our common law system, and the Law Commission has just written a brilliant report on this, actually copes with the daily development of technologies automatically. So the UK is in actually a better position than it may look, but we do need some clarifications from government, and the Law Commission has specified what those are. So we need to get on and implement them. That will pull us back into a better position.
And is this going to add liquidity to markets more broadly?
Yes, so there are really 3, I think, big advantages from tokenisation. One is you can increase access to assets that individuals perhaps previously couldn't own. So you're increasing liquidity in illiquid assets. You're potentially lowering risk in the system, and you're lowering costs in the system because you may, by automating on the back of smart contracts attached to these digital tokens, be able to reduce some of the infrastructure costs that currently underlie the system. And the EU, I think, has made a really significant contribution in estimating that there are very substantial savings in infrastructure costs from digital tokenisation.
Well, look, while we've got you with your chair of UK finance hat on, the big commercial banks are going in to see the FCA today about savings rates. What does a best-case scenario here look like for the industry?
So I think we, as you know, got round the table with the Chancellor a week or so ago when there was big concern about mortgage rates, and we created the Mortgage Charter with the government, which is now being implemented. We're very, very concerned about the small number of people who are having trouble paying their mortgages, and we wanted to put in place a process so that they could feel comfortable approaching their bank early, talking to them about how they could be accommodated, and us doing everything we possibly can to accommodate vulnerable customers or people in need who are struggling with their bills. Now there's a concern about savers and are they getting good rates. The first thing I would say is that this is more a problem about, as you, in fact, yourself said, I think, in an interview a couple of days ago, this is more a problem about education and inertia than it is about the availability of rates. I looked on the way here on moneysupermarket.com. One of the UK's leading high street banks is offering 7% if you're prepared to tie your money up for 12 months. It's offering 4% just for a month, up to £50,000, which is more savings than most people who save in this country have. So it isn't actually about the lack of availability of good savings rates, either on an instant access or on a term basis. A lot of people don't know this, and even those that do often don't spend the time to move their deposits around and take advantage of higher rates. So I think what have we got to do as an industry is we've got to make sure we're communicating really robustly with our customers, telling them what's available and then helping them to move where there are better rates available.
And obviously the other big talking point in the sector right now is this supposed closure of some bank accounts due to people's political beliefs.
Yes.
Is that ever acceptable?
No, we should, and our members, I think, would say, all of them would say that no one should ever have a bank account shut because they express a legally held opinion. No one would defend that kind of activity, but I don't believe that's what's happening. I think you'll find that in the cases of people whose accounts have been shut, it will be for other reasons. It may be because, and I'm not commenting on any particular individual here, I hasten to add, it may be because of suspicious activity in the account, which, as you know, we're regulated and have to look at. It may be because of abusive behaviour in branches. It could be a whole host of reasons, but it will never be because someone expresses a political opinion that's legally held.
All right, Bob, always good to see you. Thank
you so much for having me.
Thank you. Some other business news stories for you now, and shares of Cab Payments slipped by just under 5% when the company made its debut on the London Stock Exchange this morning. The company, which specialises in facilitating foreign exchange and cross-border transactions in emerging markets, was valued at £851.4 million at flotation, making it large enough to enter the FTSE 250 index. The flotation, one of the biggest so far this year, is being seen as a test of confidence in the UK stock market, which has seen a dearth of IPOs this year. I'm very pleased to tell you that the Chief Executive of Cab Payments, Bhairav Trivedi, will be on this programme tomorrow. The tour operator Jet2 predicted a strong summer after reporting results that topped its last year of trading before the pandemic. Jet2, which now claims to be the UK's largest package holiday provider and third largest airline by number of passengers flown, reported a pre-tax profit of £371 million for the year to the end of March. That was up from a loss of £389 million in the previous 12 months, but was also 48% ahead of the year to March 2020. Well, the company, which recently announced plans to begin flying from Liverpool John Lennon Airport from next March, said it would be offering 7.5% more flights this summer than last year. The global recruitment services firm Robert Walters warned this morning that it was still not seeing any signs of improvement in trading. The company, which specialises in placing skilled professionals in sectors such as accountancy, banking, engineering, healthcare and technology, said that net fee income in the 3 months to the end of June came in at £99.9 million. That was down 11% on the same months last year. The fee income was down by 21% in the UK, which the company said reflected recruitment confidence, having been hit by high inflation and interest rates and layoffs in the tech sector. Well, last night's minutes from the latest meeting of the Federal Reserve's Open Markets Committee, during which it was pointed to a further US interest rate rises, sent Wall Street lower. And that was followed by declines overnight for equities in the Asia-Pacific market. The main faller there, the Hang Seng in Hong Kong, off by more than 3%, as you can see. That's been followed by declines across Europe this morning. All of the main continental European indices in negative territory right now, all down by more than 1%, in fact. Well, here in London, it's a similar story. The FTSE 100 is down by getting on for 1.5% right now in a broad-based sell-off that's taken it to its lowest level since March the 24th. The leading fall in percentage terms is Flutter Entertainment. Elsewhere in the FTSE 100, Next and JD Sports are among other fallers. That's because they've gone ex-dividend today. They're trading for the first time without rights to the latest payout. Not too many gainers to mention, but you can see in the middle of the screen there, United Utilities up by just over 1.5%. It got a push from one of the brokers this morning. Outside the FTSE, the hedge fund manager Man Group is ahead by more than 2% right now. An acquisition of a US credit manager called Varagon has been well received, but the office-based provider Workspace is off by more than 3.75% right now. That's on a trading update. Elsewhere, the electric vehicle charging firm Pod Point is down by 11%. That's after its chief executive unexpectedly quit. On the foreign exchange markets, well, the dollar had a bit of support last night from the Fed minutes, but you can see sterling is ahead by 0.5% right now against the greenback. Sterling also up by 0.25% against the euro. The single currency, meanwhile, is 1/3% higher or so against the dollar. The oil price, meanwhile, is grinding higher following this week's news of Saudi and Russian production cuts. Barrel of Brent crude is more or less unchanged right now. Barrel of Brent crude currently changing hands at $76.60 a barrel. As I say, more or less unchanged. Joining me this morning is Janet Murray. She's head of market analysis at RBC Brewin Dolphin. Janet, good to see you this morning. I mean, obviously, the Fed minutes dominated events over the last, 12 hours or so, really.
Hi, Ian. Thanks for having me. Yes, absolutely. So I think the Fed Chair Jay Powell, he has been saying to markets that the pause in the Fed funds rate was actually unanimous, but ultimately the Fed minutes surprised markets. Actually, it wasn't. Actually, it was quite split. So some members actually don't really agree that the Fed should pause. So I think that is more hawkish than markets have expected. And we knew that the markets haven't really priced in as much interest rate increases as the Fed has been guiding. And the market continued to price in rate cuts for the next year. So I think that's why markets were unpleasantly surprised.
Yes, and that's followed through into Europe today. Now, the other big global story that everyone's watching right now, Janet Yellen, the US Treasury Secretary, has just arrived in China. I mean, are we expecting anything really significant from this visit?
So I think we have to manage expectation. I think the visit is basically trying to improve relationship, which has turned a bit sour. So the both sides haven't really been talking too much. So it's really a way to improve communication. So there are several topics on the table to discuss, especially for the debt relief by China on emerging markets. For example, China being a big creditor. And also, of course, recently China has just imposed restrictions on exporting certain metals, which is critical to the technology industry. But also at the same time, the US is having this ongoing export restriction of advanced semiconductors. So, there is a lot of things to discuss, but I think it is right not to have too high expectations. More like is this ongoing dialogue to improve, yeah.
Now, closer to home, of course, a lot of action in UK gilts over the last couple of weeks, and markets are now pricing in rates peaking at more than 6%.
Yeah, absolutely. I think that is a big move, and certainly one of the reasons why European markets, especially UK, the FTSE 250 is weaker, because markets are now pricing in 6.5% peak UK interest rate sometime in March next year. So that is actually a significant increase from previous 6% being expected. Remember, we came from all the way from market expecting 5 and then 6 and then now 6.5%. So where is the peak? I mean, JP Morgan yesterday, there's an economist warning that rates could hit as high as 7%. I mean, not necessarily that would happen, but it just shows how markets are getting nervous at how high interest rates in the UK can go, and certainly hitting the house builder stocks particularly in the FTSE.
Yeah. What sort of implications do you think this is going to have for sterling? I mean, obviously the pound is up quite strongly today. I mean, if this comes to pass, presumably it's going to grind much higher.
Well, theoretically, because that's really because of the high interest rate that attracts capital, especially versus the other economies. For example, the US, they paused in June and they may not hike as much anymore, whereas the UK has further to go. But then I think economists and traders, they may shift their focus from the interest rate difference to the growth weakness in the UK going forward. Because ultimately, if we were to see rates as high as 6.5%, we are very likely to see a recession, which if we have a weaker economy, that would weigh on sterling eventually.
Absolutely. Janet, always good to see you. Thanks for joining me today.
Thank you.